Good morning. I'm Lex, your host. This is Traders Workshop. And today we are going to pull back the curtain and see what's behind the dark pool. So stay with us. Dark pools and trading off exchange today. Look at you.
Lex, when you point, you have to point at the camera, not at your monitor. You're like,
oh my God, you're a nut. Hello, gents. How are you?
Good morning.
Good morning. Welcome. All right. So first things first, we are going to start doing these about 45 minutes earlier going forward. Is that right?
yeah.
So the game plan is to start at 7:45 Central Time, right? 8:45 Eastern. So that's 45 minutes before the opening. We figured that people maybe want to catch the open. So now they'll be able to do that. So we'll do about a half hour, 20 minutes right before the opening. Then you can get to your morning opening, make your trades, get on with life. So starting next week, we'll do that, which is perfect. That'll be tough on the West Coast. That's 5:45, right? But we'll figure it out. None of us on the West Coast. Yeah, there you go. All right. So couple things today. We're gonna talk about dark pools. Mark's gonna be our man here, and we're gonna talk about trading, off exchange trading. So, this came up a couple weeks ago, maybe last week. The question is, how much liquidity do market makers really consume? Meaning, are they really 95% of the other side of our trades? Maybe not. Probably not that high, because Mark introduced this concept of dark pools and trading off exchange, which can be stuff that's crossed and what have you. But I'll let you explain. So, Mark, I'm going to turn it over to you to help us out with what all this stuff means and how do we keep track of it?
Yeah, it's a great question. And I think, the answer is going to differ very significantly between whether you're talking about equities or whether you're talking about options, right? Equities are very much an order-driven market. Like, two sides are pretty easy to match up in, not just the most liquid names, but in any name. Options, that's why you have dealers. That's why you have liquidity providers. That's why you have people incentivized by the exchange to post two-sided quotes in the market. So I think if you're talking about option orders, you're looking at a much higher percentage of orders that are matched against a market maker compared to in the equities, even though there are, of course, equities market makers also.
Can we define dark pools first?
Yeah. Go ahead, Mark. Sorry. Jason asks, can we define what a dark pool is?
So my colloquial definition, I didn't look this up specifically, but a dark pool would be a mechanism that is not an exchange. It's most likely registered in ATS, but is some matching engine, some program that connects buyers and sellers in a way that isn't lit. So dark being the opposite of a lit market, like the NYSE or the NASDAQ or ARCA. So lit exchanges tend to post the bids and offers. They tend to be public. They tend to be all part of that regulation NMS, where orders have to be routed to lit exchanges. Dark pools are hidden. The depth of liquidity is hidden. The size of the orders in the dark pool is hidden. The other side's best price is hidden. And dark pools offer a lot of functionality to kind of lean on that hiddenness to better price orders for both sides. That you can really show size liquidity at a price without really necessarily, spooking the market, so to speak. It does a lot of like midpoint matching. So there are a lot of benefits to trading, quote unquote, in the dark. And I think that's why dark pools have become so popular for both securities.
What these dark pools, they're regulated like the lit markets, right? So it's not like this is going off exchange and illegally being posted, right? Obviously it's not illegal, but who's the government? I mean, the regulating body, sorry.
Yeah, so the idea of an order taking place and getting consummated off an exchange really became popular like in the mid 90s. So like Instinet has existed as a dark pool for like 50 years or something like that, that they traditionally would just match like large institutional orders. But kind of because the NASDAQ market makers in the early 90s were very greedy and posted wide markets, they got into a lot of trouble for that. And there was a little bit of a backlash. And that allowed for the creation of these mechanisms that could affect a trade and then just post it to the market. So it's in equities, you can match an order and then just report it to the tape. You report it to FINRA's trade reporting facility, TRF. And that is an actual trade. Whereas in options, it still needs to be matched on exchange. There's still like liquidity matching mechanisms, off exchange liquidity mechanisms that people use to match a trade, but it still has to get crossed on an exchange. Whereas in equities, it does not.
So if an options trade still has to get crossed on an exchange, there's the possibility that the buyer and seller in that match trade don't actually come together because any market maker or other market participant can break that order up. Is that right?
Correct. And the main ways that you would cross an options order on an exchange would be, obviously you can have a broker bring it down to the floor and the market makers can say, I'm interested here or there. But like most of it is done through the electronic mechanisms, the price improvement mechanisms. So an auction order, a paired order, that order gets paired off exchange. The buyer and seller agree to a price, or more like the sellers compete against the buyer's price, or the liquidity providers compete against a customer order that they see in this mechanism, and then that pair goes down to the exchange where it gets subjected to another level of price improvement auction, through SIBO, AIM, COLA, Felix, any of those mechanisms.
Okay. Jason, does that all this make sense?
Yeah, it makes sense. I just if all that liquidity is hidden, nobody sees any of the orders that are in there. So whenever I get a order executed at midpoint, does that mean it's a dark pool because the best bid and ask are not posted on my execution price?
So from an options perspective, like when you send an order down, it's generally getting bought by a wholesaler on the other side. And sometimes that's wholesaler can be a single entity that it's just, Citadel's the one on the wheel, Susquehanna's the one on the wheel, like whatever liquidity provider dealer is on the wheel, they get that order, they get the right to trade that. And they'll match it immediately and put it through the price improvement auction. Price improvement auction actually isn't dark. Like the prices that are disseminated from that are totally public. Like the notification of that order is public to anyone that subscribes to that feed. So like the price improvement isn't what I would consider the quote unquote dark part here. The dark part would be if instead of, on that wheel of wholesalers, TD Ameritrade's orders go into this wheel and next is Citadel, next is Susquehanna, next is Morgan Stanley, start the wheel over. Instead of one single person being on that wheel, it would be a group of people. And the group of people agree to buy that order. And then that group of people is a dark pool that would compete. It's not exactly a dark pool in the same way that you have equities dark pool. Yeah. So like I'd be careful about, being too strict about that definition. It's an off exchange liquidity mechanism where multiple dealers can compete to be the one that brings that order to the exchange, rather than it going to a single entity.
Yeah. So is that volume tabulated in daily option volume and stock
100%.
volume?
It gets printed to the tape. An auction goes up, and I believe most of the timers are sub 100 milliseconds at this point.
Okay, so it's part of the volume that we would see in a retail environment or in the market making environment. We see that volume. It's counted.
100%. And those are all the price improvement statistics that they're either bragging about internally or externally. And the wholesalers definitely have specific criteria that they have to meet. So like deals will look like, hey, you can have this slice of our order flow, but we want to see payment numbers of X and price improvement figures of Y. And the broker will monitor that each wholesaler is sort of meeting their standards of 30% price improvement or 50% price improvement. So it gets very closely monitored.
Yeah. And then, so Jason, how would you take this data? Because I'm guessing that most of this stuff trades midpoint plus or minus, right? It's small degrees around that. So you've got to tabulate, is that liquid dealer taking that liquidity or not around midpoint? Does that get more difficult for you?
Oh yeah. I mean, so we found when we were developing Voland that midpoints, and especially, even if you're on the wrong side a little bit, dealers could be on the wrong side of the midpoint just a little bit at times. And what we ended up doing is using two factors in order to try to kind of categorize it correctly. The first is using the surrounding orders, both the executed and the orders that are offered out there. So I mean, if the bid and the ask is say $1 and $2, and somebody puts in a bid of $1.65 and it waits a little bit and then it gets executed at the bid, that would look like a sell by the customer, but it's really a buy. So you kind of we have to look at the surrounding orders there for that. And also we use fair price modeling. So we kind of using Black-Scholes, it comes up with a fair price for each option. And if the execution price deviates from the fair price and it's different than whatever the midpoint is by a significant amount, we switch the dealer thing. So yeah, it is pretty complicated, or it complicates things, and especially on the wings, it's still, because it's illiquid, it's still like we still get it wrong sometimes. Occasionally, like the JPM trade, the Seagull, we typically get that really deep sold put out of the money wrong, like Volin does. But on the plus side, unless there's a massive sell-off, a lot of times those strikes don't get reached. But yeah, so I mean, especially in illiquid options, it gives us a lot of problems.
Yeah, makes sense. So Mark, why would this dark pool isn't necessarily available to the everyday retail kind of person, right? I'm assuming it passes them by.
It's one of those things that's going on behind the scene once you send your order in. And I think like one of the big takeaways is to think about what levels might you be getting price improved at if you're watching where your orders are trading. That it's worthwhile sending in levels that are likely to get picked up. If you tease something out too much, no one's going to want to step against that. And there are different rules about how the orders that are marketable versus non-marketable get tabulated. So like the incentives of the dealers will ultimately impact the levels of where your trades might get executed mid-market.
Okay, so if you hit the send button on your application, right, or the buy button in options, it could go to a dark pool, but you don't know.
It could. I my guess is less than 20% of it does. I think for the most part, we're looking at single entity wholesalers on the other side of this.
Okay, so it sounds like back in our day we had I don't know who it was, Morgan Stanley or Smith Barney come in and they have this this massive trade that they want to put up, and inevitably the market makers are trying to block that because we want one side or the other. And then they go put it up off somewhere else. That was the beginning of the dark pool way back then. So, okay, we're going to cross it elsewhere.
The shenanigans that go up. Whether it's a flex trade or whether it's like running around to a couple different exchanges to get it put up. But at the end of the day, every option order is subject to some degree of price competition. There are QCC orders, right? Still qualified contingent cross, but that has a couple qualifications, as the name suggests, and doesn't really impact retail orders. That's, I think the minimum is 1,000 contracts per leg there.
Okay. So it's not like a one lot's hitting these dark pools at all, right? If you're a one lot trader, that's just going to the consolidated marketplace and for auction, right?
Yeah, someone's bringing that to an auction, whether it's the wholesaler or some wholesaler that won that right in the dark pool.
And what's the definition of a wholesaler in the equation? So you've got market makers out there, you've got weak customers and traders, you got the market makers that you and I know, and then who's this wholesaler? Is that like a broker? What is that person?
So wholesaler is sort of an operation it's a traditional market maker that is that has those dealer rights on an exchange, but that also purchases order flow. And so they're the ones that contract directly with the brokers of customer order flow to have the right to execute that customer order flow. Okay. So rather than just standing on the exchange and taking whatever orders come in or responding to whatever bids and offers are in public mechanisms, they directly source their own pipe of retail order flow to execute as a broker and dealer with sort of the two match sides.
Okay, but they can also take the other side of whatever that, if they're a wholesaler, and if it doesn't fit into their theoretical model for whatever reason, they pass it into the marketplace. And this happens instantaneously, I'm guessing. It's based on a value situation for the wholesaler. He says no good, pushes it out to the marketplace, and it gets executed at best X there. Is that right?
Exactly. And it's really kind of a crapshoot, right? On any given order, which dealer might be getting your order and whether they're full or not, or, what that all looks like is really random at the end of the day. There's nothing you can do to necessarily control that. But you're right that they have the choice to either post it or they have, the right to match it and put it through a price improvement auction.
Right. Okay. And again, when it sounds like this takes a long time to do all this, but it's nowadays it's instantaneous.
Milliseconds.
Right?
Yeah.
Okay.
Sub milliseconds, honestly.
So,
to do
yeah, if you're a large trader and you're sending massive orders out that might run through this mechanism, you don't even know the difference, right? It's just like right through the wires.
Yep. Some of the auctions are interesting in terms of their market structure, in that some are totally price blind, but some will show the dealers subscribe to the feeds what the updated auction prices are, right? So market's $1.50, initial matched order comes in to sell it at 140. And then another offer comes in to say, hey, I do that at 138. And that 138 offer might actually get displayed to people who then might come in again. So, there's this idea that publicly disseminating them encourages competition. But then there are other auction mechanisms that are totally price blind, where it sort of encourages people to give their best and final, right?
Yeah.
Which exact one is giving better price improvement? I mean, I don't even know that there are academic studies that are analyzing that.
Yeah. Okay.
All right. I got 2 questions.
Shoot, Jason, go.
All right. Number one, because I get approached a lot since I provide data, and there are other services out there that provide dark pool data that I guess comes available for free from FINRA at the end of the day. Is there any kind of, I guess you could say, indicator that you can base off of these dark pools that can help you decide a market direction or any kind of market movement?
The FINRA, so the FINRA, to be totally explicit, that data is all for equity dark pools. So what you can tell from them, I mean, I think it's more interesting at an overall market structure level, where transactions are taking place, rather than necessarily anything directional about a security, and it doesn't even necessarily mean who's buying is more sophisticated because it's in a dark pool or not in a dark pool. I don't know that there's much in those tea leaves to read at a very high level. Those dark pools are constantly managing their flow, because as in an equities dark pool, if you're registered as an ECN or an ATS, you can regulate who comes in and out of your dark pool. So if you have a counterparty that's particularly toxic, and is always they will actually remove them from the dark pools. And so the actual pools themselves that have an incredible amount of data about what's going on in there, they'll make a lot of, the pricing changes, market model changes, participant restrictions, based on how the activity is trading.
Yeah. I mean, I did a lot of kind of research, just using that dark pool data and some of the data that other people provide, like dark indexes or whatever. And it didn't seem to have any correlation with market movement at all. I mean, conceptually, it seemed like it made sense, but I just couldn't find any kind of relationship. And that's why I don't include it on my service or anything, because I don't see any edge in it. But the second question I had is, obviously payment for order flow, you just kind of described, kind of sifts through a dark pool first, right? Because a wholesaler gets it. So is that considered dark pool, or? I
would not necessarily consider that a dark pool. And I think to be very precise, what I would consider a dark pool in options as it exists today is not even really what the dark pools are in equities. It's more like it's a liquidity mechanism that isn't necessarily a public exchange. And it's, the ones I know about are regulated like an ATS. And, it still is a registered, transactional venue, but ultimately all that's doing is automating negotiations that would be taking place over IM or something like that. So it's automating that, and then it still has to go get crossed in some type of like public auction mechanism. Whereas a dark pool trade in equities, very fundamentally different. If you agree to a trade in that ATS, you can just call up FINRA and say, hi, 10,000 shares of Apple traded at 162.50. Like Lex is the buyer, Jason's the seller. And like that's a consummated trade.
Okay.
Which is a major difference.
So the exchanges don't like dark pools. That's a competitor. These IM services.
Very much so.
Yeah. So any of that stuff in options that goes up dark pool wise, it's not necessarily going to SIBO or MyX or any of those sort of places, right? It trades.
No, it does not. That's the really important difference, is that the like dark liquidity mechanism in options, the like off exchange liquidity mechanism, just matches things up before they hit the exchange.
I gotcha. So they pick their exchange where they cross this or put this up.
Correct. That's part of the whole game of being like a wholesaler, is like knowing which exchanges, which what price structure you're looking at. Are you hitting tiers over here? Is this a customer order? Is this a taker order? Am I getting broken up a lot on the PHLX and symbol XYZ? How has this been trading? How badly do I care about this order? Like they have a whole sort of soup and algorithm to route that order based on all those factors.
Okay. Interesting. Okay. Wow.
So I guess that means that there's not a lot of option flow that's on a dark pool.
No, they're really not. And there's nothing in options that doesn't trade on an exchange and doesn't hit the OCC volume.
Right. Okay. Interesting.
I mean, maybe there is, but like those are like OTC contracts, right? Like that's
right.
Yep. Okay. Well, so Jason, you'd still see this data anyhow. So the Volin would pick this up. You just have to interpret it the best way you can.
Oh yeah. I mean, there's always some like mechanisms in the background, and as long as it's fed through the Oprah feed, which that's what we're collecting it from. So, and if no matter like even if the option trade goes through to a wholesaler and then the wholesaler puts it on the exchange, we're still we're seeing it at that point, not at I guess necessarily that payment for order flow point, but we're seeing it when it crosses when the final trade is executed and put on the Oprah feed.
Right.
Yep. All this stuff sort of happens in the background in like a couple milliseconds of haze before everything hits the exchange.
Yeah.
What percentage, Mark, do you think? I don't expect you to know this. What percentage trades through this dark pool in option or equity first, then options? What do you think? Do you have any idea?
In equity, I believe it's somewhere between like 45 and 50%.
Oh, that's significant.
Yeah, there's a ton of dark pool volume out there.
Okay. In options, what do you think about options?
So in options, I'll sort of back into it by saying like my rough rule of thumb is that like a third of volume is customers, a third of volume is professionals, and a third is dealers. And so, that ebbs and flows, right? Like during the pandemic, like that retail slice, like definitely ticked up. But if you roughly go that like, a retail customer is on one side of, 35, 40% of volume, then close. So of that order flow that comes in, you got to ask what's marketable and what's non-marketable. The non-marketable stuff is going to get posted to an exchange. So that's $1.50. Customer comes in 120 bid. They just tighten that market. No wholesalers taking the other side of that.
Right.
So non-marketable flow, I think, is something like a third of the flow, and marketable flow would be like 2/3 of the flow. I'm getting rough with these numbers, but just for purposes of extrapolation.
Yep.
So 2/3 of the flow is marketable. That's going to go to some sort of price improvement auction or, the pre-exchange mechanism and then price improvement mechanism. So if you're talking what percent is hitting auctions, you're talking 20, 25% of OCC volume is in auctions.
Okay.
If you're talking like how much goes through a pre-exchange liquidity mechanism, the dark pool of options before it hits those, real back of the envelope, we're talking somewhere between 10 and 15%
Okay.
of that retail flow.
Sure. Right. Interesting. Okay. Yeah. So, I guess the for me, the fascinating thing is how this all works. You think now in the new world that we're in, you just hit a button on your screen. And after you hit that button, there's so many places that order can travel.
So many fixed messages get traded
God.
before you get your fill.
And it happens like that. So it's amazing, man. No wonder why I got out of market making. Now I know why.
Oh, see, this is the stuff that I'm fascinated by. This is my bread and butter.
Oh man, I don't know if I want to be on the other side anymore. I know I don't. Too many machines.
It's a competitive game. I mean, because and people have like such a negative connotation of PFOP because it just sounds dirty, right? Like it's payment for order flow. But like actually the power dynamic always shifts depending on like what exchange rules are, how much order flows come in. But like the last 10 years has been great business, for both sides, but like, the brokers can squeeze these dealers more and more to provide better and better price improvement. And like that tightens markets, that gets better fills for customers. Like more payment comes back and shows itself up in the form of like improvements to your trade workstation, like, like all those things that like brokers need to like run a good business. Like, I actually think that like the competition there has really been a boon for retail traders.
Oh yeah, it's certainly tightened up the markets, like you said. Now you can do this now so much more easily with all this liquidity that's there. It's amazing.
All right, last question.
Yeah, we got to go after this. Sorry.
Okay, so the SEC is trying to make auctions and trying to mess with payment for order flow because they feel, I guess, it's not enough price improvement. Do you agree with? Do you take the SEC side or do you take the exchange / current I guess mechanism side?
I think there are plenty of cracks in like how order flow is necessarily bought and distributed right now. But I think those are more like minor level rule changes rather than, it's speeding up the pitch clock. It's not like giving people metal bats.
I see.
Yeah. That's right. Well, listen, payment for order flow has been around for a while. We did it as a market making entity. We were very much involved in that back in the day. That was a critical part of our business strategy, right? So it at the end of the day, it really, really helps the retail customer tremendously. It's amazing the difference.
Absolutely. And I mean, it offloads a lot of the like execution manipulation of an order to people that are doing that all the time. And a broker can be a broker facing entity. And instead of worrying about all the microstructure and fee routing tables, they give it to the people that are actually, very deeply incentivized to do that.
Mm-hmm. Right. All right. Very good. We'll touch on this a little bit at the beginning next time. A couple other things, but I know we're getting late here. Anything else before we close? We good?
Let's get this market to move. Can we poke it a little bit?
Seriously, these little up and down 100-point days, these are no fun, man.
I'm short gamma. I'm very happy.
Oh boy. All right. Good to see you guys. We'll see next week, 7:45.
All right. Happy trading, everyone.
Happy trading.